Okay, so this is what we're talking about. We're talking about why wobblers whisk out and how to avoid it by planning ahead. Oh, that's a thing. I probably should have removed that slide. All about me. I'm Mr. Badger. That's not my real name, obviously, but works for me. And then you've heard my backstory.
Wait,
Okay.
I want to know why you're called Mr. Badger. What's that?
Oh, I think I was reading The Kids' Wind in the Willows at the time.
Oh,
and, and and he was a suitably grumpy character, and I just didn't want to go on Discord as my own name, really. I think it wasn't even Discord, it was on anything trading related. I just decided to go with Mr. Badger. So that's I am in Beeline, like in the A3 website thing, portal thing. Well, there's a chat window. I'm just going to open that in case people ask me questions. Yeah, that's why. It's no
cool.
nothing.
That's awesome.
Alrighty. Okay. I saw that Dave had a quote, so I decided to find a quote, and this one by George Patton sort of summarize the transition I'm hoping to make in my own trading by this approach. Okay, so what are we trying to achieve here? So basically, I'm just trying to put an end to sudden death risk out, and whatever that might mean for you. So this really applies, in my mind, particularly to prop firmy type things where you can pay however many hundreds of dollars and then lose your account. It was very interesting watching that thing that Douglas posted with Angelo from TTF. That was very insightful. But yeah, sorry, I don't remember where I was going with that. Yeah, we want to make sure that our losses are always acceptable. We are going to have losses. The trick is just to ensure that they're acceptable losses. What I'm not going to do is go into detailed of any strategy or market theory or price. I'm just going to assume everyone has some working model of price action or market theory that they can use, and so on. And these principles just wrap that. Well, I will refer to stuff that Dave talks about because it's a lingua franca.
That's what the course works for, right? So, yep.
What's that?
That's what the course works, right? Are for.
Right. Okay. So why do we need to care about this? So basically, if we lose something, recovery time. So if we're expecting a 0.25% loss and we daily return, and we take a 5% loss, well, it's going to take you a month to get back to where you were, right? And that's too much to deal with, frankly. We can trade in a prop firm where we get evaluated and we pass, and we're cranking on, and we're heading towards their scaling plan. But interesting, Angelo said that he's only ever had one person get to the scaling plan. But anyway, and then we may even get some payouts, and then we lose, and we have to start all over again. And so, because the cost of a loss is so, the whole structure is so fragile that we can lose so trivially and so easily, it's important that we just never lose in any serious sense of the word. Losses have emotional costs. Recovery is overwhelming because actually, I'm just going to hit all of those because I can see where I am. Oh, there we are. Yeah, so if we know that it's going to take a week to recover or a month to recover, that's just like overwhelming, discouraging, and it has an emotional cost. Like, it's depression provoking, anxiety provoking, and all of that. And they're very felt, real things that spill over into our real life. Certainly spills over into mine. Losses are expensive. They have an emotional impact because we make them mean stuff. It might just be a practical meaning, like this is going to take me 20 days to catch up, or it might actually just mean we despair of ever reaching our goals. If you start trading in January in a prop firm with a view to being funded at, I don't know, 1 million by the end of the year, but every week you fail, then you're still at the 10,000 after 12 months, and you're just never going to get your goals. So it has that sort of impact. And so I'm not really good at this whole slideshow thing.
Great.
And it has financial costs. You're simply going to keep on paying for prop firms, and that's, you know, you're spending money, not making money. Or losing money out of your own account. It also might have identity costs. You might identify as a trader, and now if you lose, I'm always cautious of anyone that says identify as, because I don't think that model of identity is healthy, but it is what people do, and you know, so it might be playing guitar or any activity. You see yourself as that thing that you do, and the cost of failing that is expensive in terms of how it affects your way you understand yourself. And of course, there's opportunity cost. So just like I described. So I've got an example here of the opportunity cost. So this is the Concept Trading's payout matrix for their cheapest traditional model. And the way this model works is you might get in for $70, $77, you get in a $750 account, which thankfully has a 200-to-1 leverage, so you got some wiggle room. Now, every time you get 5% profit, they bump you up a level. And over 23 steps, you can get to a $7.5 million account. If it takes you if you make 0.5% a day, each step's going to take you a fortnight. That's 46 weeks to get to the top. And along the way, you'll get a 420 grand's worth of payouts. So if you can do that in 46 weeks, you had a good year. The other thing is failing every couple of weeks and just never getting past level 2. So that's an example of an opportunity cost. That's why we have to deal with this and make sure it never happens. So how do we handle it? Well, too long didn't read, just be very deliberate. Now we'll talk about what that looks like. Oh, that slide shouldn't be there. Look.
But they're key.
Hey, that was the hidden secret.
That's a hidden secret. Oh.
Sorry.
Hey, do you mind if I ask you a question real quick?
Oh, please go for it.
So, I love the fact that, you know, you've been posting 1% returns in the 1% daily club. To me, just watching your trading evolve, it seems like you've gotten more consistent. Obviously, your journey has been, like you've said, you used to risk out more, now you're risking out less. What prompted you to kind of want to share this at this point in your trading? Do you know what I mean? Like what it I mean, if you're going to talk about it, then just say we'll wait for the next slide. But I'm just really curious as to why if there was like an aha moment or something that you why now is really what the question is. Do you know what I mean?
Right. Yeah. Well, I had so I've never kind of formalized this. Like I did make an online wobble calculator that Kevin refers to sometimes in his talks, like years ago, as my first sort of attempt to make sure I never hit this state, but I still hit the state. And I've never really formally said to myself, these are the rules to manage this, because every time I think about it, I just get cognitively blocked and it's too hard. So, and I hit a state. You might notice I haven't been posting in 1% this month, just because I want to focus on this, because I hit a state just before the end of the month where I lost another. I lost the one that you gave me, Dave, the one I won in July. And I was like, well, this isn't okay anymore. and so teaching it is a way of, or at least breaking it down to the point where I can explain what I'm thinking is two things. One, it's a way to confront the thought process in my head to the point where I get it into actual detail. Because once you're thinking about something that's hard and you kind of think you've got it and you can just stop thinking about it and you don't actually think it through. And two, people can go, well, actually you're talking shit because you haven't thought of this and this and this. And then now I can hear that from someone rather than discover it the hard way. So losing that funded trader thing was a big stimulus. I lost a fairly low key and then 5%ers at the same time. And yeah, it was just my chance to force this to stop. Because even if it happens once a month, it's deadly in a prop firm context. If it's your own account, it's just annoying, right? So yeah, does that answer your question?
Sorry, I was saying yes, and I had me unmuted. So yeah, but yeah, absolutely. Thank you. I appreciate you sharing that. You know, I think as traders, sometimes pain can be the best motivator, and so I really appreciate that you've experienced pain and you're jumping in and you're sharing what you've learned from that experience. So I know, for one, even if nobody gets anything out of what you're doing, you will. And that's what this is all about. Do you know what I mean? That's what this is all about, right? Yeah, so I appreciate you doing it. So
yeah, cool. Yeah, pain. Like I mean, I remember last time I lost it. The first time I lost a couple $100, I was devastated. Like I couldn't believe it. And then I went on and lost $5,000 and 15 grand and then 250 grand. And it's like, at some point you get numb to it, right? It just becomes this, you know, you actually get numb to it. And that's not good either.
That's correct. Yep.
Yeah. Okay, so here's the scenario that occurs for me, and I suspect might occur for other people, right? When we tend to think of it as being in a marching market, being the condition, but not necessarily the case. But basically, we hang on to a trade long after we should hang on to it. Now, whether that's one position or a whole sort of wobble cluster, we hang on longer than we should. Price has moved against us more than we want. We have partial evidence that it could turn any time, right? Oh, look, it's reaching this supply and demand area. It's reaching this support area. Whatever language our technicalities in, it's reaching something that will make everything come good. And it keeps on moving and we keep layering in. And then fortunately for LBO, they just shut us down for a day at 5%. But for other firms, you lose your application money and you're done. So that's kind of the scenario that these kind of losses occur in for me. So first thing, so at some point I realized that I'd done so many courses and everyone else in the course was doing well and I wasn't, even though we were training the technology. I kind of, as the same technicalities, I realized that actually I was a problem here, and I sort of enrolled to become a life coach, just so I could get the education to fix myself, in a sense. I'll just use that term because, and to get the change in thinking needed, because I could see that this wasn't going anywhere good. And the first thing they taught us was the above the line, below the line concept, which is kind of just very useful in everything, and it really applies to trading. Because so just the psychology of this is just, I've only got 4 points. There's so many things you can talk about in psychology. A lot of people say that psychology is more important than the technique. The technicals, I don't really believe that. I think if you've got technicals, if you have psychology, you know technicals, you got nothing. So, but they certainly need to go together. And the fundamental psychological principle, I think, is what they call above the line and below the line thinking. So every time you have a thought or language or an action that is above the line is one where you're just taking ownership and responsibility. And if you're always thinking like that, you're always, you're never blaming anyone else. It's never your teacher. It's never the coach, mentor, the broker, the power outage that you just had, because you're in the habit of planning for those things and thinking for them and taking ownership of that scenario, whatever scenario it might be. Now, stress, when we experience stress, that's just a lack of control. We feel stress because things are out of our control. And so by thinking like this, you minimize stress by putting yourself in the driver's seat psychologically. Happy to unpack that if anyone wants to debate it or challenge it or work it through, but it's kind of peripheral to this, to the main point. So I just want to put it there as an underlying thing. The next sort of, this wouldn't fit into most people's idea of psychology, but it fits right into mine. And that is that you need to understand the game that you're actually playing. So if you're sitting down to trade, like what are you sitting down to do? This affects your behavior like completely. So if you're sitting, here are some possibilities. You might be sitting down to make a target, 0.5%, 1/4%, whatever. You might be sitting down to win. You might be sitting down to prove to yourself that you're a good trader. Here's my personal motive for sitting down. I used to love watching Sean wobble, and things get so out of control, and then price turns and just rushes back through all the take profits and boom, 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 boom. And that was just the biggest dopamine rush for me in my early let's try and wobble days. And I'm always looking for that. I have to stop myself. I'm always looking for that experience and recapture that experience. But that is not a good reason to sit down and trade, right? And you can't be playing that game if you want to avoid losses. Doesn't mean you'll lose this time, but you will eventually lose if you are doing anything other than that first one. You're just trading to make a target. Now, people will say, well, you're trading you're wanting to be a consistent, profitable trader, and that's the game you're playing. But I would argue that that's just the how. That's not the actual game you're playing. The game you're playing is to get in. If you're playing soccer, you get in, you get a ball in the goal, and you get off the field, after a time. So here, we're just playing to get in, get our 1/4% in this, or 0.5%, whatever, and get out. And that's the game. And you have to know that that's the game and always be behaving like that is the game. Once you know what game you want to play and you got some ownership, then you can have some clarity, right? And now here's what clarity might look like. Oh, shit, slideshow, sorry. Yeah, here we go. Right. I'm reading off something else, sorry. Okay. If you've got clarity, there's a whole lot of psychology that you don't even have to deal with. It's just dealt with by default, which is one of the reasons I prefer to be very complete around technicals than get too navel-gazing on the psychology. Psychology is only useful to a point, but it's useful. Okay, so clarity, what are you playing? Well, here's how you demonstrate clarity. You've got your plan. So in trade fund, we're talking about the ABCs. You know where your action points and your KPIs are. You know what you're willing to lose. You know where you're expecting your trades to get out or get secured. You know if you're going to take a high probability, big volume trade, you know that is a high probability trade. You're not being hopeful. You know when you're in an outside range or in a range or in trending momentum, like you know what the market is doing and you're playing that game. You're getting in, you're getting out. This fosters clarity. It means your actions are happening in finite, effective cycles rather than a blur of trading activity. And it keeps you on purpose. Typically, when I've traded for the last 5 years, I get in. It's like getting in a pool, and I'm just splashing around in the water of the markets, having fun or not. But that's what I'm doing. If you don't have all of these in place, you set yourself up for a loss.
I like that. I like that slide. I like that. Thank you for sharing that. That's really good.
Oh, which one? The one before it? That one?
Yeah. All of it.
Oh, cool.
But yeah.
So a lack of clarity. You need to be able to recognize when you've moved into a state that lacks clarity, right? For me, this is when I start just anxious clicking. Like I'm in trouble. The dopamine says you need to do something, do something. And of course, what we do when we need to do something in trading is, well, sometimes I like to draw trend lines because I feel like that, but if I draw it there, price won't break through it. But that actually isn't true. But one thing we do tend to do is like click, 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 you know, add more trades, maybe it'll work out. So the solution to that is you predetermine your trade locations, just like Talon does. And that's one thing that Talon really consolidated for me. Like when William's little plan that comes up in the Talon expert log, it's like, oh, I could do that. You keep your targets, whether it's via a top take profit line or just by watching and clicking, at likely places, not unlikely places. And a really good, these are your action points, really. The armpit of a V is a really good example. Does that make sense? The armpit of a V, you know what I mean? Mm-hmm. Let me know if you So prolonged trading sessions, well, we've kind of just talked about that anyway, but just get in and get out is your alternative to that. And then do it again. So often, like when I trade, I get in about just before Tokyo Open, and then sort of half an hour after Tokyo Open, I've kind of had an iteration and, you know, maybe made 0.25% or 0.2% or something like that. And then I just do it again and do it again. And that's when I'm successful, is when I'm getting in, getting out. And that way, all of a sudden I have to go into a school run where I'm not trapped with trades that are left running and all of these kind of scenarios. So getting in, getting out is an important mantra. Get out and iterate, sorry.
And not over trading, right?
Right. Well, and that's anything running, like I run out of bullets. How often do I run out of bullets? Jesus. Yeah, that's if you're in that situation, you haven't planned ahead. You haven't done what I've got written here. And so that's how I also know that I haven't been conscious and deliberate when I'm trading. Oh, and I'm forgetting to click again. Am I? Okay. All right. Okay, and finally, psychological skill is accepting disappointment and knowing when you're wrong. Oh, crikey.
Thanks, referee Pete.
Yes.
Yeah, most important psychological skill in the world, generally, being able to accept disappointment. And second is knowing when you're wrong. So being unwilling to accept these things means that we end up like trying to force trades. So even when things are going to go against us and we know it is, but it comes back for that small profit, man, I just hang on thinking, oh, it'll come good and I'll, you know, yeah, but no. If you've got evidence that you're wrong, get out, pick your moment and get out, accept that you're wrong. Mm-hmm. And it's okay to feel a bit down about it. Just get up and go again. So here's a process. So that was all the preamble. Hopefully you're not all asleep now.
No, I love it. You're doing great. It was awesome. I love it.
Okay. So to get a bit of process around this, firstly, you need to know your tolerance for loss. Like, how much are you willing to lose? So I had a picture. Where is it gone? There it is. Okay, cool. Right. So this is easy in normal trading, where you place a trade, like, you know, like every other trader outside of Sean's influence does. They place a trade, they have a known stop loss, which has a known percentage and has a known take profit, and that's easy to manage, right? You start wobbling and you're like, I really don't know how much risk I've got going on here. So we need to understand that, and we'll come to that in more. I don't know. I think I might have got this out of order somehow, but anyway, the point is, you know how much you're willing to lose. That's a real point. And when your wobble cluster gets out of control by that amount of percent, you need to get out. You need to accept that you were wrong and get out, even if it's about to turn. but we'll talk about reducing the likelihood of those two not coalescing in a minute. You have to know your playing field. So you've got your market theory, whatever that is, and where price is likely to go, and that's your playing field. You get your price cycles into that and everything like that, and this is the area that you're prepared to operate in. So these are my understanding of Dave's KPIs of these would boundary my playing field. So here's a typical, upwards trend, and on this simple pull, on this sort of impulse here, I've got a higher high and a lower low, and that becomes my playing field, and that's the area I'm willing to trade within, and we'll unpack that more in a minute. I also use other things like where I can get those to coincide with Asia or UK, US session highs and lows, and daily highs and lows and things like that. But that's all just technical asides. Everyone's got their own model there. Right, then you next bit of the process is you need to get your as part of your playing field is your ABCs and your 1, 2, 3s. Okay, so I've kind of got my 3 price cycles in. So that square down, you can't even see my mouse, can you? Can you see my mouse?
Yes.
I don't know.
Yep.
Right. So these squares are about a price cycle, which maybe I can draw. Can I draw? Oh shit.
Zoom education meetings are on Fridays. I need some too. So
I think I've got it here. Woo!
Right.
All right. So that might be a price cycle there. That might be one there, and then there's sort of 2 of them there, right? And these 2 are sort of squashed together. But so I try and get my price cycles in here to coincide. Now, if I have very small price cycles, I might need to either decide that I'm only going to trade in that box there, or thin things out and trade 6 price cycles. But these are all, you need to work out how you're going to rationalize your price cycles and your playing field, but you do want them to approximately coincide, because if I go below here, I really don't want to be long anymore. And so, yeah, that's all part of your ABCs. So you've got what your trend is, where your action points are, where your KPI is bound to your playing field. And now you've got a known sort of set of concrete parameters that you can allocate risk into, which I hope is the next slide.
And I love how you're really just broken that down, talking a lot to traders about those 1, 2, 3s, right? Those first 3 steps that will help. Well, with me, the psychology, right, of even just and the anxiety of even just getting into a trade. So it's very well done.
Thanks. Yeah, if you know what your technical rules are, and are very concrete on those, you can just alleviate a lot of psychological activity. I didn't mention here, but here's a 1, 2. Oh, okay. 1, 2. Yeah, a 1, 2, 3 there too. But yeah, I meant to go into it anyway. Okay, so that's what I just talked about. I've got my price cycles mapped into my playing field. Now I need to plan out my allocation, and this is where rubber and road meet. So as Dave has talked about before, now where did I find that pencil-y thing? There it is. Okay, we need to keep half for allocating, for fixing an opportunity, and I've done that wrong. Oops. Yeah, sorry, man. I'm just having Zoom and slideshow interaction issues. Okay, right. So we got 50. What do you call those things? 50 bullets in Alveo. And based on the maths we'll talk about in a minute, you might want to then allocate a certain lot size to each of those bullets. You want to slice half of them off, because you might get an opportunity to just go in heavy and and pull 5 pips out that are really profitable, or you might get down here and decide you really need to fix things, and you're in obligation mode as Dave says, and you need to get to break even so that you don't have a disaster on your hands. But you can't do that if you haven't very deliberately and consciously made sure that half of them are aside for that purpose.
Yeah, not only for taking advantage, right, but also getting fixing those trades were upside down is right. And so
right,
nice. We still got the drawing on there. Was that pertinent to this slide?
No, it's just the anxiety of finding an eraser and erasing.
Don't even worry about it then, my friend.
All right, but here we go.
I just wasn't sure if it was that part of it.
That's cool. Okay, so I literally do this when I trade now every day, every time, is I just draw in my price cycle boxes and I put numbers there. And when I'm at that point, I want to be in that deep and no more.
Okay, that's cool.
Because then I'm not subject to thinking, oh, it's moved, I'm going to click. Oh, it's moved, I'm going to click. Right, which works fine when you have an infinite number of what do you call them? Bullets, but it doesn't work fine.
Positions. Yep.
Now, where is the trading session starting on this chart? Yeah, that's a fair question. I'm just going to take the very naive thing and say it's starting the first price cycle. It's sort of in this area here, somewhere in here. Not at the top of a rectangle, because that would be buying at the
top of your price cycle.
The wrong end of a price cycle. But I'm not saying where the trades exactly have to be. I'm just saying by the time I get here, I want 3 and as low and close to that as possible. So I would just pick, more likely I might put in 1 here.
And you do the four boxes, right? Each time, you said?
Yeah. I used to do 8 boxes because mainly most of my trading now is just around Tokyo Open and through Tokyo morning, really. And often price moves 8 price cycles or whatever. But now I find if I rationalize those to a structure, then I can keep that. And the 4 box really is my fix-it box. I don't want it to get into the box.
If you have to, you're prepared for it. Yeah, you've outlined it. So that's really good.
Right. So in this scenario here, we really didn't get down to the 6. So this probably wasn't super profitable unless we actually kept it for the ride of the wave and on it went. But it's just, the first one I found this morning when I was throwing this together. All right. So this is what I call a layer plan. And so one thing I wanted to, what I've written for myself is just a little Ruby script that spits out a layer plan and shows you, and what I wanted to do for this session was to just wrap it in a UI, so you could just go to a web page and experiment with different layer plans and see if it goes down 5 layers and back 2, what's the profit, right? And so that was what I'd hoped to do, but I just haven't got that far. But I often do that because I've got margin calculators and things in there. So if I'm copy trading to 5%ers and copy trading to CTI who are 1 to 20 and someone else with 1 to 10, like my Darwin 0 is 1 to 10, then I need to know that my copying won't run me out of margin, right? So it's all fine for me to sit on CTrader and have my 1 to 100 and it's all just going fine. But if my destination is actually saying, no, I can't take that trade because you got no margin left, then you got a problem. So all it does right now, I'll show you in a sec, is it just spits out a spreadsheet with no formulas in it, but I'll wrap it up in a web UI so you can just like play with the different parameters and see what the different, you might want 1, 6, 18, 30, right? As long as you don't go over your 50 on LVO, for example, and that would give you different amounts of movement before you can actually your WWL has become profitable. So, anyway, we'll get to that, I hope.
Win-to-loss ratio for us newer traders.
Right. Okay. And the main point is, of course, is that these price cycles represent a pyramid, basically. And if you can get a like, so now, why didn't it draw? Drawing. So if you can get a pyramid like that, if you can get a pyramid like that, that's awesome. But if you can get a pyramid like that, if you know what I mean, even better. So, but that's all very secondary. Okay, so then we've done all our planning, and now it's time to play the game. And the process is get in, get out, iterate. Right. So get in, get your 0.1%, and then do it again. And you do that 3 times, and in our Forex regime, you've got, and you need to do that 3 times, right? Mm-hmm. Make sure you're in the right mode for the market. So you don't want to be riding the wave while counter trending, for example, and all of that kind of thing. Use adding trades and peeling losses to keep a break even very close, and use an acceptable risk amount. Now, I think this is where I ran out of. I didn't get to finish the slides before I got to finish the. Oh no, I did. Hang on. So for some reason, it's because I'm in draw mode. Sorry. Okay. All right. So. If we've got a 10K account and we've decided our acceptable loss is at 1.5%, which is $150, or it's 15 pip by lots, we can layer using this plan, for example. You want to make sure that you're still within your available bullets in a A3 type situation. And then you can just do this simple kind of maths. So yeah, you've got a 10 pip price cycle. You can go, and you've decided 3 at the end of the first price cycle. So using that layer plan there, you could go, 30 plus 120 is how many drawdown you're going to have, which means you've got half a lot, sorry, 0.05 of a lot per trade to play with. And doing that quick maths, it makes sure that your larger price cycles have a smaller lot size. Right. Yep. So price isn't going to run away from you so quick. Now, because I've organized my price cycles and my playing field to coincide, if I get to that 1.5%, I should be at my KPI that says it's all over. So, so what my hope is that puts an end to the discussion of, it might turn, because now I have technical evidence that it probably won't. So it's a lot easier to then accept that 1.5%, because the catch is it's going against you and you think, but it might turn. But if you've set up evidence that it probably won't turn, you can go, okay, it's over. And if I lose 1.5%, I can trade again later, but I could have an extra trading session that day, or maybe 2 extra, and make it back. Or or if it's not going to cost me my week or my month, for example. So I'll just show you an example of that layer plan as a spreadsheet, if I can get up into this window. Can you see that? Oh no, it's very small. But can you physically see it? It's on the screen.
Mm-hmm. Yep.
So, for example, if we've got four layers. If we go just using these we're concerned with these. If we go 4 layers deep, draw down 4 layers deep before coming back to the 3rd layer, well, that means we would have made $36 in whatever scenario I set this up with, versus $99 by cashing out at the bottom of the 4th layer. Or if we had have let it go up to the 2nd layer, we would have made $171 dollars.
Nice.
Yeah, and then we've got the percentage drawdown at those layers. And for non-LVO type accounts, the margin that we would have used. But anyway, I hope I can I can organize a way that you can play with that tool by wrapping. At the moment, I have to run this Ruby script and then open up a spreadsheet and import the CSV, blah, blah, blah. So, and I thought, oh, we'll do this talk in a couple of weeks and I'll have it all ready. But anyway.
Yeah. This would be like a
Martin has one in Excel. So yeah, that might actually solve the problem. So I just saw that comment. Thanks, Martin. So theoretically, we've reached nirvana, except we haven't, because there is a downside to all of this. And the downside is you might cap your bigger wins. So, for example, going back a few months, most of my bigger wins would have been basically just layering in too heavy, let it wander way too far away, let it come back, and then get all my take profits. And that was all very exciting to watch and very stressful and quite the hoot and a lot of drama, but and often return big wins, right?
Yeah.
But it's like no way to trade consistently, and it's one way to ensure that you do have big losses as well, even bigger losses. So by taking this approach, I get less big wins, right? But I get fewer big losses. And the idea is to get 0 big losses. And where it used to take me, I don't know, a couple of hours to get 1% or whatever, now it might, at the same time, might only yield me a little less than 1% or 0.5% or 0.7% or something like that. So that's a downside. But the upside of that, of course, is you're going to be a lot more consistent. You're not going to be getting kicked out of your prop firm thing. And your net profit across time will be higher, I believe. Right. So, but if you still want the big wins, well, can we compensate that? And I would argue that's actually the wrong question, because what we're exchanging here is sort of sexiness and drama for peace. However, the upsides from a pure profitability point of view are, one, if I'm no longer adopting the hang on tightly and watch price move around and see if it gets to my take profit, I'm much more likely to recycle my trades. And that in itself, in many market conditions, will give you a better return than the drama of waiting 12 hours for it to go 60 pips one way and 60 the other. If you have managed your pyramiding correctly, and your bottom is significantly heavier than your top, then you're actually probably going to find opportunities for big wins that just were not available for you before, right? And finally, you're going to have bullets available to actually cash in on those trades. And just like back in this scenario here, right? So here's a rover wave opportunity. If we had a layered in coming down and then back up and then put in a secured trade there, we might have actually just taken the profit on the secure trade, or it might have just kept on going for the rover wave. So we're creating an opportunity to do that.
I like what you said, the opportunity, right? By planning ahead with that, with that chart, for example,
right.
I think is, we say, hey, if this in fact does go, we have a couple of levels where it could, do our test, the 0, 1, 2, 3, and possibly ride the wave. So if I build into that, I have a higher probability of trading or of profit. But like you said, recycling those trades, right? I think that was a very adamant point. For me, I know that risk management and well, just planning ahead has helped me to be able to recycle those trades better. So.
Right. Yeah. And Talon really sort of drove that home. Using Talon really made that clear.
Yeah.
And the other thing is, if we've got, it didn't used to take me that long to run out of bullets, and then it was just hope and pray that everything turned around. And there was no margin left to cash in on clear, obvious, high probability, moves and pullbacks or whatever. And now there is, and that actually can counter. So yeah. My last 2 points, which never made it to a slide, are that just to optimize your chances of not being in a bad situation, even after all, is counter trend trading works better when you're countering harmonizers with a higher time frame. And we really probably cover that most hot seat sessions anyway. But yeah, if you can align with your 5 or 15-minute time frame from your 1 minute, then you've got less chance of things swinging out of control. And like that session that Duke ran a few weeks ago, like changing direction and having understanding price action, like doing the study to understand price action well enough to know that, say, when your 5 minute is changing direction, you're much less likely to end up in a bad situation where any of this really has to have its value. And that is that.
Beautimous. Beautimous. No, a lot of value points that I think that traders are going to go, walk away with. Yeah, it'd be great. Again, there's a lot of, sharing that information for us to be able to access, once we got it all finished up, and then have maybe a part 2 where you're not just put on the spot so fast. That's what we like to do, though. Put you on the spot. But a great, great presentation. Probably open it up just for some quick questions. Maybe go over some of the comments here. If there's any questions, go ahead and type them in. But yeah, Martin had a great, your risk adjusted profitability is better than your growth probability, right? If that's lower. Right.
I mean, if you're following the rules and the most you can lose is, let's just say you've decided 1.8% is your get out, then you've only lost 1.8%, and you can make it back, and therefore you never need to lose your prop firm evaluation. That's what I'm telling myself.
Yeah.
And planning on, and so on.
I think it makes a huge, again, just from I can only really speak from my personal trading experience, but if I get stressed out, right, the trading psychology is too much for me unless I actually have tried to develop or have some set of rules, right?
Right.
Nick asked if we could, if you wouldn't mind going back to the slide where you showed the example of the calculation of max loss of 1.5. Mark says, I find it great. Metrics is return and max drawdown.
Is that what you're looking for, Nick?
What's that? Nick wanted to know if you could go back to the slide where you showed the example.
Is that the one that he's talking about?
The 1 point, the max loss. Yep. Okay. Yep.
Just to comment on Martin's comment, the only problem I have with that metric is actually tracking said max drawdown, like your max adverse excursion. When I get a spare weekend, I just want to put together a couple of little, I guess, indicators that actually sit there and just record that and dump it, so that I can go back over it, because Duke manages it manually, I think, but my head doesn't have the space to do that.
And also there's the layering calculator, right? That Duke's had, and again, I think just another sign of how unique our community is, right? Everybody sharing their perspective, their hard work, right? And for us all to share into and get something from. That's any other questions or points? Getting close to the timeline. David, any insight or thoughts that you had?
No, other than this, I appreciate this, Glenn. I really do, because you're taking everything that we talk about every single day and you're getting it, you're doing it, right? And so for some of you guys who are just like, if you're watching this at a later time and you're like, what is he talking about? Like, there's a lot of things out there that we use our jargon or ride the wave or different things like that. You've learned a lot of that, and so you're using that, and it's really kind of exciting for me as a teacher to see that you're grasping that concept. So I appreciate this a lot, that there is actually one person that's using it. We found him.
One.
We found him. We found the one. No, but in all seriousness, if the, I think that it's awesome. So I appreciate it.
For sure.
I mean,
Go ahead. Good.
I'll just say, look, thanks, Dave, because I mean, after February and I got into the Discord, and like the value is extraordinary, and I mean, you already know that, but it might be worth hearing. I don't know, but just I used to go back, like I used to find all just watch every hot seat I could, and like just zone in on, just wait there for a key, idea. Like I think 99.9% of these ideas are literally almost a transcribe from something you said at some point, because I just used to parse them and parse them and parse them, and yeah.
For sure.
I appreciate that. Yeah.
And I think risk tolerance, obviously, of course, is a crucial point or part of the system, right? Having our 1, 2, 3s, I kind of call it, for the analysis, trade management, trade execution. But I like how you put contingency, right? What happens if we do? If we're upside down in those trades? And I think it helps. Well, at least for me, helps with the psychology, and kind of stops my thinker from thinking too much, right? So,
Right.
but kind of on that note, we have David just finished up enhancing the Ride the Wave system, adding some really great additional learning modules to it, and again, the Ride the Wave, the price action breakout, the methods and the self-guided material in that coursework, is really helpful for me, and has been. It's helped me, and then of course, really try to couple that with a few live training, and I think that for anybody that's looking to help manage their risk, know what system to trade when, I think that if you're not part of the Trade the Fund, don't have access to those, I highly recommend it, because just for me, it's helped to have the self-guided coursework that I can go to, the live sessions, helps me recognize which market conditions to trade which system is. So go out and get it, and let me know if we can help in helping you get to where you need to be.
And I have to say, mashed potato.
No,
Potato.
you don't have to do it. You just fall into peer pressure.
That was the greatest sounding mashed potato accent I've ever.
This was going so well tonight. It was going so well.
Until that. Yeah.
That's okay. I have full editing power.
You can bloop it out.
There you go, Nick.
Yeah, but no, again, great presentation, Glenn. Thank you so much, and I'll keep everybody posted. You let me know when everything is ready, and we'll do a part D all together. And now Brandon wants a doll, so but very much appreciated, good sir. Thank you so much.
Thanks. That was fun.
Yes, sir.
Thanks for forcing me to think it through. I've been avoiding it for a long time.
Well,
Yeah.
and that's the thing. So if you're sitting on the fence, I mean, let's just be honest here. I mean, you did a great job. I think everybody could see that the nerves were there, but you still did it. And that's the point, is like, you will get better because of this, because of the effort that you put in to do the research, to put your slides together, to put your presentation together. That's really the point of these Wednesday night meetings. And so if you're sitting on the fence and you're like, well, I don't think I know enough to present, that's when you should present, right? It's not necessarily the guru. I want this platform for these nights, Wednesday night, to be exactly what you gave tonight. and really have the benefit to the instructor. It really is no benefit to the instructor if you get on and talk about something that you've talked about for 1,000 times over and you could speak it, in your sleep. It's really the effort that you put into putting this together. And so I applaud you for doing it. And if you're and I know that you'll get better because of it. Do you know what I mean? And so I appreciate that.
Yeah, thanks. I feel quite relieved actually having to put it through. I'm like, that's actually all I need to do. That will solve, you know what I mean? Like it's gone from knowing that there was this idea out here that is probably, going to work to like, actually there's no reason. Now it's clear. I could, so anyway. Right, percenters here.
It was great. And then of course recordings will be available, and then if you're so kind to let us post the material somewhere where we can, once you're finished. We'd love to do that. We'd love to be able to go over it and look over it, because it's I think pertinent for me, definitely. So.
Oh yeah. Cool.
All right, with that, I think we'll call it a night. Dave, got hot seat.
Yep, we're gonna move into some night trading. So
yes, sir.
We'll jump over there. And we're good to go. So
Nice.
The other thing I'll just add is like we did upgrade our site, so everybody should be experiencing faster speeds, all that kind of stuff. And it should be up and going. So I'm excited about that. And we have some awesome things that are coming down the pipe too. So all right, thank you guys, and we'll see the hot seaters over into some night trading if you want to join us over there.
All righty, thanks, y'all.
Thanks, guys.
Appreciate it. See ya.